Hello and welcome. In this lecture video, we'll be talking about valuing accounts receivable. And basically, we're going to be talking about what happens when one of our customers doesn't pay us, right? How do we deal with that? So far we've been assuming that our customers always pay us, but that's not always the case. They have a situation where we have a receivable, an accounts receivable. We made a credit sale to a customer, and after 6 months, they're just not going to pay us. Maybe they went out of business. Maybe they have lost their job. They can't pay us for whatever reason. And so we need to talk about the journal entries for how to deal with that situation. Okay? So what that's called is bad debts. That's what I'm saying right over here. Uncollectible amounts are referred to as bad debts. Okay, so we'll talk about that as bad debts expense. So when a customer can't pay us, we have to recognize bad debts expense. That's what that is. So there are two different ways that we can account for bad debts expense. And by the way, I'm on page 177 of your course pack. This lecture video will talk about the direct write-off method for accounts receivable, for dealing with bad debts expense. The next lecture video will talk about the allowance method, okay? So let's talk about the direct write-off. So when we use the direct write-off method, basically what happens is we say, we made a credit sale to a customer, and then maybe 6 months, a year, whatever time frame, some longer period of time goes by, and that customer has not paid us. And so when we realize that that customer is not going to pay us, we recognize bad debts expense. Now, bad debts expense is another expense on the income statement. So just like rent expense, interest expense, supplies expense, we recognize an expense with a debit. So when we find out that, or we make the determination that our customer is not going to pay us, we will recognize bad debts expense. And how do we recognize an expense? With a debit. So we will debit bad debts expense, and then we have to reduce the receivable. How do we reduce the receivable? Well, accounts receivable is a current asset, and so the way that we reduce accounts receivable is with a credit. So let's look at our example right over here. TechCom determines on January 23rd that it cannot collect $520 owed to it by its customer, J. Kent. So on 123, we determine, you know what? We're never going to get paid by J. Kent. It's not going to happen. So on 123, we have to do a journal entry to write off J. Kent's receivable. Okay? And what do? We're going to debit bad debts expense for the amount that they still owe us that they're never going to pay us, $520. And then I will credit accounts receivable. Remember, my abbreviation for accounts receivable is AR, $520. This bad debts expense is an expense on the income statement. Okay? It's another expense on the income statement. And so by debiting the expense, our expenses are going up, total expenses will go up, and then that reduces our net income. And by crediting the accounts receivable, our total amount of accounts receivable in the general ledger goes down by $520, okay? So this is our journal entry with our direct write-off, and what we do with the direct write-off method is on the date that we determine we're never going to get paid. This is just not going to happen. We do this journal entry, debit bad debts expense, credit accounts receivable. Okay? Now, let's look at the situation on the next page where it turns out J. Kent can later pay us. J. Kent can pay us. And that's what we're saying over here with recovering a bad debt. Sometimes an accounts receivable that has been written off is later collected, maybe from continual collection efforts, for example. Could be a little bit uncommon, but it can happen. So the situation is that J. Kent, back on January 23rd, we decided J. Kent couldn't pay us. We debited bad debts expense, and then we credited accounts receivable. Then it turns out, maybe 6 months later, well, J. Kent's going to pay us. Okay, how do we recognize that situation with the journal entry? And that's the idea of recovering a bad debt, okay? You might think, well, why would this ever happen? Well, sometimes this can happen. You know, when I was at Mary Washington, I did an internship in the credit department at the Army Times newspaper. All right. And part of my job was that when people wanted to call in and they wanted to place ads in the newspaper, this is a long time ago, they wanted to place ads. They called in on the phone and they wanted to place an ad, classified ad in the newspaper. Maybe they were a plumber or they were a handyman. They're a handyman. They wanted to place an ad in the local newspaper for their handyman services. What I would do, the first thing that I would have to do is check their credit. I would look to see, well, do they have any outstanding bills that they haven't paid us? Or did we write off some accounts receivable in the past? And if we wrote off some accounts receivable in the past, right, they couldn't pay us, and we had to write off their accounts receivable, they were going to pay us that accounts receivable that we had to write off. They were going to pay us for that before we ran their advertisement. Okay, so I have seen these situations happen when I was an intern a long time ago. And yep, put it in the newspaper over the telephone. Okay, very different nowadays. There was no Facebook Marketplace back then. All right, so let's look at our situation. So we wrote off J. Kent's receivable on January 23rd. And then let's say J. Kent can now pay us. Okay? J. Kent can now pay us. So let's look at that journal entry. So when we have that situation, and I'm going to come over here on the next page, top of page 179, just so I have a little bit of room here to do this journal entry. Okay? So what we'll do is we're going to do 2 journal entries, and this is done on March 11th. That's when it says J. Kent's going to pay us. We are going to reverse the journal entry that we did to write off their debt. So we will debit accounts receivable for $520, and then we'll credit bad debts expense for $520. Okay? Debit accounts receivable $520. Credit bad debts expense for $520. So this is an exact reversal of the journal entry that we did on January 23rd. Okay? It's the exact opposite. And so by debiting the accounts receivable, now I've reinstated the balance of accounts receivable to $520. And then by crediting the expense, bad debts expense for J. Kent is now zeroed out because we debited it for $520 on January 23rd, and now I credit it for $520 on March 11th. Zero bad debts expense. The balance is zero for J. Kent. Okay? So then, what I have to do now, that's my first journal entry. My second journal entry, I have to do 2 journal entries when I recover a bad debt. The first one is to reinstate the accounts receivable. Now, the second journal entry is, what is the journal entry when we get paid? You should know this. We debit cash and then we credit accounts receivable. So on 3/11, the second one, debit cash, $520, then credit accounts receivable, $520. Okay? That becomes our second journal entry. Debit to cash, credit to accounts receivable, right there for $520. All right? So 2 journal entries when we recover a bad debt. One to reinstate accounts receivable, one to then pay off the accounts receivable. Because if you think about it with this accounts receivable, right, what I had, if we think about accounts receivable, when I made the sale, I debited accounts receivable for $520. And then when I wrote it off, I did that. Remember, I debited bad debts expense and I credited accounts receivable. So what's the balance for J. Kent? It's zero. You can't, if I skip this journal entry and just did this one, that doesn't make any sense because accounts receivable, the balance is zero. So by doing this journal entry, I do that with my T account, then my balance is my $520 in my accounts receivable, and then I can then write it off put another credit over here to zero it out. But after I wrote it off, that's all I had. I had zero balance. So I can't I can't recognize that the customer has paid me for an accounts receivable that has a zero balance. Okay, that's why I have to do this journal entry first to reinstate the accounts receivable before I recognize that the customer has paid it off. Okay, let's talk about the direct write-off method. What's the problem with it? It doesn't satisfy the matching principle. Okay, because let's think about this. So with our J. Kent, we wrote off their accounts receivable in January. Right? Let's say it's January 2019. We wrote it off in January 2019. When did we make the sale? Well, it probably wasn't in January 2019 because we probably just didn't say, well, you only have 3 weeks to pay your bill. Right? We probably made the sale in 2018. So let's say we made the sale to J. Kent in 2018, and then we find out in 2019 that J. Kent can't pay us. So then we debit that bad debts expense and we credit the receivable. When did we make the sale? 2018. When did we recognize bad debts expense? 2019. 2 different accounting periods. That does not satisfy the matching principle. The matching principle says we want to match revenues and expenses in the same accounting period. That's the problem, right? There's no attempt at all to try to match revenues and bad debts expense in the same accounting period. Now, when can we use the direct method? Why are we even talking about it if it violates the matching principle? We can use it when the bad debts expense isn't a big dollar amount, when it's called immaterial, which means it's a small dollar amount and that it wouldn't affect someone's assessment of the financial statements. That, maybe it's $10 and you wrote it off in 2019, but you know what? I still would have bought stock in the company anyways, even if you wrote it off in 2018. It doesn't make a difference to my assessment of the financial statements. Your net income doesn't really change by all that much. Okay, it's no big deal. You can use the direct write-off method and write it off in the next accounting period as long as it's immaterial. If it's material, that means it's a big dollar amount. That means we cannot use the direct write-off method. Okay? So if it's material, big dollar amount, we cannot use the direct write-off method. If it's immaterial, small dollar amount, we can use the direct write-off method. Okay? And that's basically what I'm talking about right over here. Okay? So let's look at page 181 of your course pack, and we have some quick check problems. So I want you to pause the lecture video and do these quick check problems, and then we'll come back and check it. Okay, thanks. Okay, so let's look at these problems. So the first one, number 27, the matching principle requires the use of the direct write-off method of accounting for bad debts. No, the matching principle, the direct write-off method actually violates the matching principle, and that's what we were talking about. Okay, and we could use the direct write-off method even though it violates the matching principle if the amount of bad debts expense is small, if it doesn't make an impact on someone's assessment of the financial statements. That meaning it's immaterial. If it's material, which means it's a big dollar amount, and somebody says, well, if I would have known that, I never would have bought stock in the company, then you can't use the direct write-off. You have to use the allowance method, which we'll talk about in the next lecture video. Number 33, again, you could use it when it's very small, not very large. That's why this is false. Number 146 right over here, Griggs Company uses direct write-off. On December 6th of year 1, they sold $6,300 of merchandise. On August 8th of year 2, despite numerous attempts to collect the account, they have to write it off. Debit bad debts expense $6,300, credit accounts receivable $6,300. Assuming it's material, why does it violate the matching principle? It's because you recognize the sale in year 1, but you recognize the bad debts expense in the next accounting period in year 2. They're not recognized in the same accounting period, so therefore it violates the matching principle. Okay? All right, well, I'm going to end this lecture video now, and then the next lecture video we'll talk about the allowance method. Thanks so much.